This afternoon, we take a giant step to cement American dominance of global finance and crypto technology as we sign the landmark Genius Act into law. So congratulations to everybody. This is a big deal.
Imagine a future where every dollar you spend, save, or send lives on the blockchain. No banks, no cash, just programmable money moving in real time. And that future? It's already being written. Right now. With the U.S. green-lighting stablecoins, we're watching the U.S. dollar go on-chain. And that changes everything. Let me explain why this matters more than most people realize. So what is a stablecoin? In short, it's a digital version of the dollar, pegged one-to-one to USD, but living entirely on a blockchain. It's not like Bitcoin. It doesn't fluctuate. One stablecoin equals $1. Think of it as cash, but smarter, faster, traceable, programmable. Companies like Circle and Tether already issue billions of dollars in stablecoins like USDC and USDT. And now, the US government is stepping in to regulate and legitimize them. The US is moving toward making regulated stablecoins a legal part of the financial system. That means these aren't just crypto tools anymore. They're becoming an official way to move US dollars around the world. This is like giving cash wings. Now your money can move instantly, 24/7, across borders, without banks, delays, or insane fees. That's not just innovation, that's financial transformation. We're witnessing something massive. Cash is going on-chain. Imagine, $100 billion in stablecoins today, $200 billion next year, $500 billion in the near future. That's not theoretical. That's purchasing power. On-chain. And that purchasing power can move markets fast. When money becomes code, you don't just hold dollars, you program them. Want to send money overseas in seconds? Want to earn yield with your dollars in DeFi? Want to build smart contracts that pay in real time? Stablecoins make that possible. They blur the line between the banking system and the internet.
The U.S. legally approving the creation of stablecoins means that cash and the US dollar as cash is going to go on chain. When cash goes on chain and you go from having 100 billion in cash to 200 billion to 500 billion to $1 trillion in cash, that cash on chain, which is what a stablecoin is, represents purchasing power. Purchasing power is basically the market, the market that can buy something.
That unlocks an entirely new financial layer. Decentralized apps, global marketplaces, borderless remittances, all powered by the US dollar. This shift is great for the everyday user. You get faster payments, more access, and fewer middlemen. But for banks, this is pressure. If stablecoins become the preferred way to hold and move dollars, traditional banks could see deposits flow out and never come back. That's why the regulatory battle is fierce, because whoever controls the rails controls the future of money. A government-backed framework for issuing stablecoins, think regulated USDC, backed by US Treasuries, monitored in real time. If done right, the US could lead the global digital currency race without needing a central bank digital currency. But if it stumbles, other nations or tech companies could fill the vacuum. Stablecoins aren't just a crypto thing anymore. They're a US dollar thing, and they're going global. So if you care about money, power, or the future, pay attention. Because the dollar is going digital. And we're just getting started. This isn't about JPEGs or meme coins. This is about taking real stuff and putting it into a digital form that anyone can interact with, globally, 24/7. Tokenizing real-world assets is the equivalent of email going mainstream. Big players, BlackRock, Citi, Franklin Templeton, are already tokenizing bonds, money markets, and real estate. You don't need to believe in crypto anymore. You just need to understand efficiency. Tokenized assets settle faster, trade cheaper, and are more transparent. It's like going from fax to Gmail. Tokenized U.S. Treasury bonds, over $1.5 billion already on-chain. Tokenized real estate, fractional ownership of properties worldwide. Tokenized private equity and art, once locked up, now liquid and tradable. This isn't theory, this is happening. The blockchain is becoming a financial backbone. 3 big reasons why this shift is accelerating. 1. Humilio settlement takes days. Tokens settle in seconds. 2. Access. People around the world can invest in U.S. assets without banks. 3. Transparency. The blockchain shows everything. No hidden fees, no middlemen. And with interest rates high, everyone's chasing yield, which makes tokenized treasuries and money markets a magnet for capital. We're still early, but this time we know how the internet story plays out. Tokenization will do to finance what email did to communication. Eventually, your mortgage, your retirement fund, your concert tickets, they'll all be tokenized. Not because it's cool, but because it's better, cheaper, faster, smarter. The world isn't waiting. Real-world assets are moving on-chain, and the future of finance is being rebuilt, block by block. If you want to be early to what's next, now's the time to understand tokenization.
So cryptocurrency tokenization is like the early form of email, where very few people had email, but people knew what email was, but they didn't use it yet. Real-world asset tokenization is mass adoption of email, where everyone is using email.
Remember the early days of email? Most people knew what it was, but almost no one actually used it. That's exactly where crypto tokenization is today. But now we're entering the email adoption moment, where the blockchain stops being experimental and starts powering the real world. Think about this. Crypto tokenization, Bitcoin, Ethereum, NFTs, is like email in the 90s. People had heard of it, techies used it, but most had no practical use for it yet. Then came the shift. Email became mainstream because real people had real reasons to use it. Communication, business, speed. That's exactly what's happening right now, with real-world assets being tokenized on-chain. So, what does tokenization actually mean? It's turning something physical, like real estate, stocks, bonds, art, even gold, into a digital token that lives on the blockchain. That token can be owned, traded, split up, and transferred instantly.
I mean, if the stablecoin legislation results in the type of increase in on-chain stablecoin value and the type of stablecoin issuance output that I just described, while the market structure bill takes another 6, 9, 12 months, then the stablecoin bill could end up having a bigger impact. Because it can show that our industry is not just about speculative coins or utility tokens related to, very niche infrastructures or Bitcoin as a method of digital gold savings, but that the technology has a use and a large use beyond those things.
Everyone's watching the big market structure bills in DC, waiting to see how crypto gets classified and regulated long term. But what if I told you it's the stablecoin legislation that might have the first and biggest real impact? Let's talk about how this quiet little bill could flip the narrative for the entire crypto space. Right now, the US is inching toward clear regulation for crypto. Two major pieces are on the table. One, the Market Structure Bill, which defines what counts as a security or commodity, who regulates it, and what conditions a token must meet. Two, the Stablecoin Bill, which focuses only on regulating stablecoins, how they're issued, backed, and supervised. Most people assume the big impact will come from the first one, but here's the twist. The Market Structure Bill is bigger in scope, sure, but it's also slower. It could take another 6, 9, maybe even 12 months to fully pass and be implemented.